self go be a boss. Amen, amen. Every hustler getting paid. Where the hustle go come the pay. Your own in no go take. Amen. If you don't find work, do your own. God self go do his own. And flesh go cover bone. Amen, amen. If you believe it, say amen. If you believe it, say amen. If you believe it, say amen, amen, amen. Everything you put your hand go walk. Your name go open doors. You self go be a boss. Amen, amen. Everything you put your hand go walk. Your name go open doors. You self go be a boss. Amen, amen.
And happy Friday to everyone who's on the call today. We are honored and privileged to have you on the call. I actually am honored to be on this call today because I wish that my own father, who is now 67 years young, right? I wouldn't dare say 67 years old, but 67 years young. I wish that, someone held a call similar to this when my father was 50 years of age and he was actually getting to the point of retirement, and many of my aunts and uncles as well. And when I finish today, I hope that you would be so grateful and appreciative as well of Auntie Joanne, as we call her. She's such an amazing lady. Every one of you who knows her to be such an outspoken individual and pillar of the community, that any information that she obtains or learns, she wants to share with everyone. And so today, this is actually a service call, and that is just to provide some information that is very critical for individuals who are 50 years of age and above. If you are at that point, because one of your main priorities is going to be similar to my father, who is now retired. But at that point, it was really focusing on, am I on track to be able to retire? And there are so many things that you need to be aware of and to know when it comes to taxation, when it comes to inflation, when it comes to different things regarding your Social Security benefits, all of those things. And we're going to talk about that today. And I hope that it will be very helpful for you. I'm also going to be going over some different options and things like that that are available to you. And I hope that this can be open dialogue. I'm going to echo what Auntie Joanne said, and that is if you could turn your camera on, I would simply appreciate that. It doesn't matter to me if you're cooking in the kitchen. I know that it's Friday afternoon and you're probably preparing supper, or maybe you're just relaxing a little bit. You don't have to be proper. I just would love to see your faces, and I'd like to be able to interact with you if possible. We're going to be very respectful of time here today, less than 45 minutes, and we're going to be done. But I hope that you would leave here with a sense of gratitude that some of this information I'm going to break down for you in simple layman terms to where you can understand it and hopefully apply it. And so we'll get started with that. I actually put the link on the group chat. That link, you can copy it if you just kind of hold your thumb over it. If you hold it for a second, it'll give you an option to copy. I want you to take that. And if you have aunts, uncles, anyone who's over the age of 50, if you have any aunts, uncles, friends that are over the age of 50, I want you to text that to them real quickly and say, hey, you may want to jump on this call really quick. And that's because we want to get this information to as many people as possible. Because what we are seeing in our communities, and my name is Stephanie Njoku. I know Auntie Joanne said that I am a licensed financial professional based out of actually Dallas, Texas now. We just relocated from California. But both my husband and I actually started our brokerage firm in California many, many years ago. And we host these sessions to try to help our community understand when it comes to their portfolios, especially when it comes to retirement, different things that you need to know. So I'm going to encourage you to copy and paste that link that I posted. Go ahead and put it out there on social media. Say, hey, if you're 50 years or older, you want to jump on this call really quick. If you got people, someone just joined in, you see. So if you have aunts, uncles, grandparents, anyone who's over 50, have them get on this call really quickly. They'll get a chance to hear some really valuable information. So with that being said, I'm going to start. Again, my name is Stephanie Njoku. I'm actually here right in Dallas, Texas, just relocated here from California. This call is in honor of all of the wise ones that I like to say they have charted the paths in which we all are traveling. And I want to thank each one of you for all of your hard work and service to different industries. Auntie Joanne told me that we were going to have some engineers and individuals from IT background and medical background, like physicians and some nurses. I'm actually a retired nurse executive, so I appreciate all of the nurse executives, nurses, medical practitioners who are caring for patients during this pandemic. Thank you. For each one of you who are over the age of 50 and you are doing such an amazing service in your respective industries, I want to thank you. And I hope that you find this information valuable. We wanted to shed a little bit of light on just the aspect of retirement. That's going to be the focus of this call today, because that's the primary concern of most of you who are 50 years of age or older. What we typically look at is according to statistics, and I'm going to talk a little bit about this. What I'd like for you to do is get a pen and a sheet of paper. This is going to be more of an informational session for you. And what I'd like for you to do is to just jot down what is applicable and what is appropriate for you, right? Because I really want this to be something that's more catered to you, but I'm going to do a little bit of a generic conversation to make sure that I'm appeasing the entire audience. So there is something that is oftentimes referred to as the three-legged stool of retirement in the world of finance that we talk about a lot. And I'm going to kind of explain this to you, but I'm also going to break down the three different aspects. And I want you to do a little bit of evaluation of yourself. The objective and the goal of this call is to encourage you to understand, right, what's happening with your retirement accounts, what's happening with your portfolio, also to know different options that are out there, to also help you understand that as you get near retirement, you need to understand a few things that may impact your peaceful transition into retirement and your ability to be able to retire comfortably and not have to return back into the workforce, which I know no one wants to do that. So the three-legged stool of retirement typically is going to refer to, for many of you, the three main things that most people in this society is going to depend on to retire, which oftentimes we see that that's usually going to be things like personal savings, right? It's going to be company pensions and also Social Security. Now, if I were to kind of elaborate a little bit more, I want you to look at this stool kind of like, in layman terms, if I were to ask one of you to sit on this stool with three legs, you would probably be okay with sitting on that stool. Why? Because there's a thought process that that stool is stable. I use that analogy to explain when it comes to your retirement portfolio, the more legs or the more alternatives you have within your portfolio, that is what we call a sense of securement. You probably have heard it referred to oftentimes as diversifying your portfolio. That just simply means that you have some form of stability, right? And so that's why we use the stool to kind of depict that. The same thing is with the cracks in the stool, although, and I want to elaborate on that a little bit more. That is to say that if one of these three have not been addressed properly, and we're going to talk about that, and if you don't have a deeper awareness of some pros and cons of things that you may have done with these three aspects, you may be at risk of a few things in retirement. Number one, you may be at risk of running out of money. Right? Most people in retirement, they don't necessarily fear passing away. They fear outliving their money. They don't want to outlive their money. They want to have enough money, right, to live a long life. So, but if you didn't plan properly with these three, you may run out of money. And we're going to talk about that. That's where inflation comes in, where Auntie Joanne was talking about, where if you don't understand inflation and we don't know where you may have invested or saved your money, then the American dollar gets weak over time, because if you're not outpacing inflation, then it's not going to be as valuable in the future. And we're going to talk about that. So when we look at the three different aspects, and that those cracks in the stool is only applicable if that particular aspect is not stable. And we're going to talk about that. Personal savings. Here's the truth. With personal savings, what we have found, and I want you to evaluate yourself. Most of the time at the 50-year age mark, you're either living in a state of gratitude for the for the actions that you have done thus far up to this point, or you may be in a state of regret that maybe you just didn't save enough and you feel like you need to begin to save more. Typically, you're going to have two people. They're going to say, you know, Stephanie, I feel like I've saved pretty well and I'm on track because I'm saving pretty good. Or you're going to have that person that says, you know, in my early 30s and my 40s, I probably should have been a little bit more disciplined and saved a little more. Now, I don't want you to necessarily judge it. I just want you to kind of make a note on your document of whether or not you're living in a state of gratitude or you're living in a state of regret. And it's okay either way. I also want you to look at when it comes to the amount of money that you've saved. I want you to write this down. It is very critical to know where you save the money. Very, very important. Why is that? The average American, according to statistics, and I can actually show that statistic, will show you that there's one or two things that the average American is doing to save for retirement. Most of the time, they're max funding or putting money into a variable account like a 401k or 403b. Those are going to be your traditional accounts on your jobs. Those accounts are going to fluctuate. They're going to kind of go up and down. And probably within the last 3 months or so, you've probably logged into that account and said, I don't want to look at it again, because we just experienced, because of the war and all that stuff, a major dip. And this is very nerve-wracking for most of you who are 50 years of age or over. And that's why we're going to give you some options and things like that for you to know what's available to you. Because your accounts, if you are saving for this personal saving aspect, if you're putting the majority of your money in 401ks and 403bs, these different type of variable accounts and things like that, you must understand that you are actually saying yes to unlimited earning potential, but you're also saying yes to unlimited loss potential. And I want you to write this down. At 50 plus years of age, are you okay with losing money? That's a very big question. It may sound like a simple question, but it's a very serious question when it comes to trying to plan for your retirement. Now, most people would probably say, well, Stephanie, of course, I don't want to lose any money, right? But then most people do have their money in a 401k or 403b on their job where they are actually losing money. Another thing with the personal savings that I'd like to pose to you is, if you are using a traditional savings account, right? A traditional savings account, then you are not going to be able to outpace inflation. And why is that? And this is true, factual, based on what we know the current rates of inflation is right now. And we also know the average rate on a traditional savings account. So if you're that person who you're putting, you know, $5,000, $10,000 a year or more into a traditional savings account, and it looks really nice because it's a large sum of money in there, that's wonderful today sitting here. But over time, as you near retirement and as you go on into your latter years, you're going to start to see that account dwindle, because you don't outpace inflation by 2 to 3% or so, up to about 4 to 5%. You're going to see that the American dollar is going to weaken. And we're going to do an example of that today. So when it comes to the personal saving aspect, we're going to talk today about, if you're that person who you're living in regret, we're going to teach you how you can actually be able to increase the amount of income and money that you can put away over the next 5, 10, 15 years as you near retirement. If you're that person who is living in a state of gratitude, congratulations to you. All I would say is, if you have any funds in a savings account, look at alternatives and options of being able to get a much higher rate of return on your money so that you can outpace inflation. That way that dollar continues to strengthen. When it comes to company pensions, it's very important for this particular aspect to understand that pensions belong to the company. That means that in the event that your company were to file financial hardship, right? That means that they could do away with the pension, and oftentimes they're going to do away with the pension first. That's just the truth. Typically, they're going to do away with the pensions first. And so it's important for you to understand that pensions 100% belong to the company. Another thing that I want you to be aware of is, and this is me speaking from experience, this is not just me being a licensed financial professional, this is me experiencing being a daughter, helping my father with his own pension when he retired, many of my aunts when they retired, working with them with their pensions, and also from a professional perspective, being a retired nurse executive, rolling my own personal pension plan, also working with so many physicians and nurse executives when it comes to their pensions. There's several things that I want you to know about pensions. I want you to write this down. Number one, pensions belong to the company. Pensions belong to the company. Why am I telling you that? Second thing, if you are at the point of retirement, if you're on this call and let's say you're 65 or you're 62 or you're 63 and you're getting to a point where you're getting ready to leave the organization, it is very critical for you to understand your options that are out there. Most individuals don't know that they actually can take full ownership of their hard-earned money, their pension plans. That means that you do not have to leave your pension money with that company and risk losing it. You could actually take your pension money and you can move it to what we call an external entity, meaning you can move it to another financial institution, take 100% ownership of your money, never have the dreaded risk in your retirement of your funds not being there or anything like that. The benefit of that is, I want you to write this down. If you were to look at external companies, those external companies will give you options. And this is what you want to look at. Now, Auntie Joanne is an amazing, amazing professional. She's been helping so many clients and individuals know their options. You want to make these companies work for you. What do I mean by that? If you are at that point of retirement and you have pensions, now you may not be retired from your current job, but maybe you have a pension at another job from when you used to work there. You can actually move that into an annuity. We label them sometimes as traditional IRAs and things of that nature. You want to make those companies work for you because your company is not going to give you 10% bonus on your money. They're not going to give you 20% bonus on your money. Can you imagine being able to get 20% bonus on your money at the point that you get ready to retire? That's a blessing, right? And those are things that are available for you, but you just have to be aware and know that you don't have to leave it there. You actually have an option to move it externally, and you do have the very right to make companies compete for your business. It's only going to benefit you if you do that. Now, another thing that I want to talk about when it comes to company pensions, and this is being recorded, so if you want the recording, you can get it. And Auntie Joanne is going to be reaching out to you, and my phone number is there. We want to help you, and we want you to know your options. The next thing that I want you to understand and know about pensions is this. Most of the time, company pensions, and this is me speaking from experience of rolling many different types of pensions. Most of the time, they're going to give you a language of a tier payout, or they're going to give you like a lump sum. So they will say to you, when you get to the point of retirement, you can take the lump sum payout, or you can take this lifetime payout, which they usually do it on a tier, right? Tier 1, tier 2, tier 3, all the way up sometimes to tier 5. Every company's pension has a little bit of a different language, but what I found over doing thousands of them, they typically are going to overlap in the language, and they are going to kind of mean the same thing. And that is, if you come in and on your pension and you take lump sum option, that's where you can take full control of your benefit that you've worked so hard for over those years. You can move them out to an external company, make the companies compete for you on your behalf, get bonus incentive on your money, make sure that your payouts go to your beneficiaries, and also get a pretty good amount of lifetime income. So that's that aspect. The last aspect of this is to make sure that you understand to read the very fine print and language in your pension. Why is that? Most of the time, individuals who are nearing retirement, because your mind is so focused on, I want to make sure that I have money coming in for the rest of my life. Now, typically, if you work for like the prison system in your respective state, sometimes state programs, they work and function a little bit different. So make sure you just read the fine print and ask the questions. You can write this down if you'd like. And this is simply because I love Auntie Joanne, and I promised her that I'm going to share as much as I can with my experience with dealing with retirees. You want to ask your HR department, the individuals who are over your pension plan. There's language in there if you take a lifetime payout. You want to make sure that you understand how that lifetime payout works. The main question that you want to ask them is the lump sum amount that you quoted me. So let's say, for example, that someone says that they have a lump sum amount of $1 million after they've worked for a company for, say, 30 years. And the company says to you that we'll give you $1 million as a lump sum payout for your pension. Or you could take the lifetime payout and we'll pay you, say, $5,000 or $6,000 a month, for 10 years payout, right? Well, what that typically means is this. Let's say, for instance, if Miss Clara's on the call today. And Clara, thank you for being on camera. Clara, let's say, for instance, she has, let's say she has 3 beautiful daughters and she's worked at this company for 30 years. And they say, well, Clara, you've got $1 million in your pension. You can take this, or Clara, we can give you $6,000 a month, right? And we're going to do it on, say, a 5-tier payout. Let me give you guys an example of what that means so that you understand. If Clara forfeits the $1 million and takes the, say, $6,000 payout monthly, it sounds like really good and comfortable money. But if she has 3 daughters, let's say, for instance, she takes a 5-tier payout. What they're saying to her typically is, we will pay you for your lifetime only. And that means that for Clara's lifetime, they're willing to pay her the $5,000 or $6,000. But now the tiers come in that if she assigns a beneficiary, they will only pay that beneficiary in the event that the 5-year tier is not up yet. So for example, if Clara says she retires, she's taking her lifetime payout, she's getting $6,000 a month, and God forbid she passes away, say in year 3 or 4. Well, what happens is her beneficiary is only going to receive that continued payment for the remainder of the tiers that she selected. Because when you take the lifetime payout, they're only going to pay your beneficiary up to the tiers that you select or the language in your contract. The rest of the funds that you worked so hard for, it actually stays with the company. And that's the truth. I've talked to so many HR representatives, and what they will say many times is, Clara, it is for your lifetime only. I want you to listen to that. For your lifetime only. It is exactly what they are saying. It's for your lifetime only. Now, we all want to live a long life, but if we were to pass away early, I know that each one of you also want to make sure that your hard-earned money goes to your beneficiaries. And that's one benefit of moving your funds externally to a different entity to take full control of them. So I want you to make sure that you ask those questions. Social Security benefit, that's going to be the third aspect. Probably every single person on this call, and I want to interact with you guys a little bit. Go to the group chat. I just want you to put on there, if you are dependent on Social Security, just say yes, right? Just go to the group chat and just say yes. Most Americans, and I like to ask this question sometimes because, believe it or not, most Americans have already decided within themselves, I'm going to have Social Security when I retire, right? They've already said, I'm going to have Social Security. So I want you to go to the group chat. It's on your Zoom, right? At the bottom, there's a little button that says chat. I want you to just say yes or no. If you are depending on Social Security, if you are thinking, I'm going to have Social Security, because the most people who are planning for retirement, they've already made up in their mind, well, I'm going to have my Social Security benefit, right? So once you go to the group chat, will you have Social Security, right? I love that. See, Clara said no, Joanne said no, Constance said no. You guys are a sharp group. Now, guess what? No, wait, who said yes? Let's see who said, okay, good. Mr. Williams said yes. I'm very happy to have someone that says yes and have some that says no. Well, the truth is this is an informational session. And this is why I like to ask the questions. I like to ask the questions because the truth is At present, the Social Security system is still around. Why did I ask the question? For the sake of you all understanding the aspect of the three-legged stool of retirement, when it comes to trying to make sure that your retirement portfolio is stable, it is simply for you to understand the history of the Social Security system, for you to also understand the current state of the Social Security system and the futuristic look, right, of the Social Security system. So the truth is when the Social Security system, let me give a little bit of background on it, because I promised Auntie Joanne that I was going to explain a little bit, because I wanted you guys to really get the knowledge. If you don't know how the Social Security system works, this is really quickly how it works. You have to have so many workers, right, paying into the system for so many retirees to get money in retirement. That's how it works. When it was originally developed, right, back in the 1940s almost, right, you had to have so many people put into it for so many retirees to get out of it. Now, the truth is when it was originally designed, and you can look this up, when it was originally designed, you had about 45 workers per retiree. I'm going to say that again. When it was first designed, you had 45 workers per retiree. Right? About probably 10 years ago, it had scaled down and we had about probably 20 plus workers per retiree. Sitting here today, it's down to almost probably 6 or 7 workers per retiree. Now, I'm not telling you not to depend on the Social Security system. I'm not telling you to depend on the Social Security system. I want you to understand the facts, what's happening with it, and then you have to weigh out, do you think that it's going to be around for you? One other piece of the Social Security system, if you were to open up, if you're in this call and maybe you're in your latter 50s, going into your 60s, maybe you have received a Social Security statement or something like that. If you open that Social Security statement up and kind of read the fine print, you're going to be able to validate what I'm about to tell you. And that is the Social Security benefits statement has even stated, it's been publicly put out there. I mean, it's all out on like the news and everything. And the statement kind of generalized says, if we don't see changes to the Social Security system by 2026, that we may not be able to pay out the full, right, benefits of the Social Security. That just simply means that they may not be able to pay out what you should have received. Now, me being a millennial, I'm 38 years old, so I'm a millennial. So if I were to go to the group chat with you guys, right, I'm going to put my response on there. No. Now, that doesn't mean that I'm telling you to depend on it or not to depend on it. We're going to work in facts today. And that way it empowers you to be able to know if you should be dependent on it or not. Me being a millennial, watching the trend of the system, knowing what they've put out there, I personally am not depending on it within my portfolio. So I hope that you would understand that I'm setting the premise for the call today, and we will still be done in less than about 30 minutes. The call is about understanding what are you doing for your retirement right now. You're taking notes, so I want you to write down what's in your portfolio. What do you have in your portfolio? The more things you have, whether that's you have real estate, whether you have alert plans, life insurance retirement plans, which are a tax-free way for you to be able to have income coming in, whether you have company pensions, whether you have savings, all these different types of things. What do you have? But the bigger question is it in the right areas? And are you getting the right interest on them? That's the bigger question. The next thing that we're going to kind of go over real quickly is what you need to know as you plan for retirement. Well, this is something that Auntie Joanne was talking about, and this is what we call inflation. When it comes to your retirement, it's very, very, very critical to understand inflation. There's a book that I highly encourage all of you to read, and it's called The Power of Zero. The Power of Zero by David McKnight. The reason why it's important to understand that is because the Power of Zero really kind of tells you, as a person who's planning for retirement, you have to understand that if you're putting the majority of your retirement funds in tax deferred accounts, meaning you're putting all of this pre-tax dollars into these retirement accounts and growing all of the capital, not necessarily considering two major things that's going to impact your retirement so critically. Write these two things down: taxation, and also inflation. Taxation and inflation. If you are not outpacing inflation with the type of accounts that you have, you're going to see that your retirement funds are going to eventually dwindle slightly. If you're not looking at making sure that as you plan for retirement over these next several years, that you have money in accounts that's outpacing inflation by 2 to 3%, you're going to see that the dollar is going to weaken. In that book, if you want to write that down, The Power of Zero by David McKnight, he talks about looking at your portfolio and trying to shift toward a 0% tax bracket. Now, you may feel like, Stephanie, that's kind of absurd. I've never heard of that. The truth is you can actually get to a 0% tax bracket. That means that most of your investments, your savings and things like that for retirement, you have put them in an account that is going to be rendered under IRS standards as a tax-free stream of income. There is a way for you to be able to get to a 0% tax bracket. There's also a way for you to outpace inflation, and it's very important for you to know how to do that. This was just, and this one is not to 2022, because of course 2022 just started, but I went back as far as 2013. This was from the Federal Reserve Bank. This is just to kind of give you at a glance when it comes to inflation, right? When it kind of comes to understanding inflation. And if you look, the black line, right, bar graph from 2013, kind of go to 2021. Auntie Joanne was right, though. It cut off at 2022 because we just started it. But according to statistics with the Federal Reserve Bank, we're almost at an all-time high of almost 6 to 7% on inflation. It's going to impact retirement. You got to plan for it. The black is just a median 1 year ahead expected inflation rate, and then the pink is just showing you like a median 3 year ahead. So it's just kind of showing you where it is. 2021, right? You can only imagine in 2022 where inflation is. If I were to explain to you inflation in layman terms when it comes to your retirement and things of that nature, is basically where the cost of goods and commodities increase, over time, right? So you have to make sure that your investments and your savings are also getting interest, right? Competitive to be able to stay abreast of inflation. Because, for example, let me give you a layman terms example. Many of you, if you're in your 50s on this call, like my father, he's 67. So he used to tell me when he could walk in a grocery store, and all of you probably can remember this. You can walk in a grocery store, you can buy a loaf of bread. Maybe that bread had like a 99-cent stamp on it. You remember you could probably buy bread for like 99 cents or maybe even less than that. But today, sitting here in 2022, you can't go in any store and find that same loaf of bread, right, for 99 cents. That's what you call, right, commodities increasing because of inflation. Everything is increasing because of inflation. Here's an example of that. Let's do it together. If you had, now this is an example for each of you to look at. This is going to help you understand that you got to look at where you're saving your money. How much interest are they giving you? Are you outpacing inflation? I'm going to say by 3 to 5%. If not, this is going to be a prime example of what's going to happen to you over the years. And I'm very grateful for Auntie Joanne for putting this call together to bring awareness. Here's an example. If you had $1,000 in the bank at the start of last year, let's just say last year, 2021, sitting here today in 2022, it's worth $930. Let that sink in. All of us have $1,000 last year, January. Sitting here today, if it was in the bank in a traditional savings, right now it's about $930. If you had $10,000 in the bank, let's go back to 2000. In 2000, now this is in a bank. I'm not saying that if you invested it in Amazon stocks or anything like that, money that you got sitting in a bank. If it's in a bank, in 2000, because we're in 2022 now, guess how much that $10,000 is worth today in 2022? $4,500 when you consider inflation. This is what I mean by the dollar weakening. Now, all of you are planning retirement. So I want you to understand something. If this example is very true, right? Then what's going to happen? What's going to happen when you are 10 years into retirement, 15 years into retirement, 20 years into retirement, if your funds are not outpacing inflation? You can see pretty quickly where you could run out of money trying to buy the normal goods like everyday commodities, groceries, putting gas in your vehicles. We could even remember when gas was probably $2 or $3 less than what it is today. That's the importance of understanding to put your money in the right place. $1 today is not $1 tomorrow. Can I tell you something? This is why wealth is built by investing. It is not built by saving. You have to understand where to invest your money. You have to understand how to outpace inflation. This is what we talk about for retirees. It's called getting a grip on your funds. It's a rollover. I'm going to talk to you about options that you have. If you're 50 plus years of age, giving you some examples of what you can do to safety net and shield your money, to make sure that you never lose your money, to also make sure that you stay abreast of inflation. You can even set your accounts to where your payouts can stay with inflation. We call it an inflation payout. So for example, if you're 50 plus years of age on this call, two things. If you are currently still working and you're not 59 and a half, I'm going to say that again. If you are currently working and you're not 59 and a half, you cannot do internal compensation and roll money with your organization. But you can if you have left an organization and disassociated with an organization. If you want to protect your hard-earned money, you want to stop it from fluctuating in the market, there is an option for you and for those of you who are 59 and a half. So if anybody on the call is 59 and a half or above, and you currently work for your organization, the IRS knows that you're so close to retirement, there is a law in place that allows you to internally move your funds and protect them, because they know that typically it takes about 7 years or so for the market to correct itself. Usually around 59 and a half, you have access to funds that are in your 401k, 403b, not your pension. If you still work for that company, you can move those funds to what's called a fixed index annuity. And I'm going to give you an example. I had so many different illustrations of clients that I've helped, but I'm going to just show one of them just to give you an example. It's a fixed indexed annuity that you do have the option to roll your funds to. Why would you want to do this? Well, if you're in your 50s and if your risk tolerance, if you're that investor that says, Stephanie, I've worked hard for my money. I am nearing retirement. Joanne, I do not want to lose my funds. I've worked hard for them. This is an absolute guaranteed product. It's a guarantee that you can go to sleep at night. What's happening right now in the market because of the war, where people's funds are fluctuating up and down, you can immediately stop that fluctuation and put guarantees and guardrails around your hard-earned money to make sure that they never fluctuate again in a fixed indexed annuity. You can make sure that you have a very competitive rate of return. That's going to make sure that you outpace inflation. That account historically has done on average somewhere about 5.67%. I've seen them go as high as sometimes almost 14%. Depends on if you have different strategy riders on there and things like that. You can be guaranteed that you're going to always kind of outpace inflation in those accounts. You're going to have index style growth, and I'm going to explain that to you. If you look over here on the right hand side, You see this red squiggly line going up and down. That's kind of an example of what we call a variable account, which is what your 401k and your 403b does. It fluctuates. That's what's happening right now because of the war and things like that. You're going to have it go up, down, up and down and up and down. I just had a really tragic, sad situation with a respiratory therapist supervisor who had been working at a level 1 trauma center for the last 28 years. He retired in December, right? Only for us to finally move the funds here. We did this last week, and we had been trying to get that money out of the market with 3 different companies. He lost a total of $80,000 from December to the point of moving. When you call your companies and they tell you at the close of business day today, this is the value of your account, that's what they're telling you. That's that red fluctuating. That means that your money is going up and down. Well, if you move those funds to a fixed indexed annuity, Joanne is well versed in this. She's an amazing, amazing professional with many different A+ rated companies, according to Standard & Poor. She knows how to shift those funds and immediately stop them from going up and down. And that's what you get in these accounts. You get index style growth. Also, if you are that person who you're 59 and a half or above, or right at about 60 or so, and you know that you're going to retire at 65 or 66 or 67, and you want lifetime income on your money, the beautiful thing about these accounts is you can move those funds and you can already say to the company, when I'm 65, you could be 55 right now today. And in 10 years, you can go ahead and tell that company, hey, I want you to tell me how much money you'll pay me for the rest of my life. If you're 60, you can put it in an account where you can lock it in for 7 years. And you can tell that company, hey, I want to know how much income you'll give me for the rest of my life. That's what we call pension income for life. That's being able to go to bed at night knowing that you're going to have money coming in from many different sources. And I want you to remember something. If you don't remember me telling you anything else, make companies work for your money. Why am I telling you that? They want your business. The beautiful thing about what Auntie Joanne is licensed to do, she can make companies fight for you, meaning they will give you 10% bonus on money, 20% bonus on money. It's free money out there. You just have to know, right, that it is available to you. I want you to make those companies work for you. I'm going to give you an example of if you're 50. Hence, we're on a call with some amazing 50-plus-year-olds, right? I trust God that I'm going to be able to get to where you guys are. You're teaching us young millennials, right, how to travel this journey of life. I'm going to give you an example. 50-year-old, right, with $250,000, how it works. We have something that's called compounding interest versus simple interest that you get on typical accounts in the bank. Well, let's say, for instance, if you had $200,000 just sitting in a traditional bank account, move that money fast because you want to move that money to where it works for you. Watch what $250,000 could do for a 50-year-old in a fixed indexed annuity over time. You take that $50,000, make that company work for you. They'll give you a bonus. That money goes to $275,000 day one. How does $25,000 sound? I'm going to show you an example of me doing just that for a principal who retired last year. $275,000. So $250,000. It doesn't matter if you have the money sitting in a bank or if you have the money at an old company in a 401k or 403 or whatever. We label them as qualified and non-qualified funds. You can turn that money to $275,000, get $25,000 right away. Well, watch this. Because of compounding interest, when you are 51, that money could turn into $300,000. Now watch it, 7 years rolling, it's gonna double on itself. 51 at 58, that 250 could now be 600,000. At 65, that 250,000 could now be 1.2 million. And at 72, that 250,000 could be 2.4 million. That's what you call compounding interest. That's how you make sure that you outpace inflation. You're never going to get that with money just sitting in a traditional savings account. Never. You want to make your money work for you, right? And that's what we teach you how to do. And that's what Auntie Joanne is also licensed to be able to do. I always like to give live examples of clients who have given me the approval to use theirs as an example because they were just so happy about their accounts. This is a gentleman who actually had about $1 million after about 32 years of working. It was about 1,060,000. I'm going to explain this to you really quickly in layman terms. If you remember, I said there are companies that will give you bonus on your money. Well, immediately upon moving the $1 million, that money went to $1,272,000 because of the bonus that we were able to get him. So he went from 1,060,000 at the point of retirement. We immediately got those funds to 1,272,000. So when he got his contract in the mail, his contract did not say 1,060,000. It said 1,272,000. Now he's 69 when he moved the funds. He was very well off. So he said, you know, Steph, I can start income when I'm 72. I'm not in a hurry. Now, there is something that is called required minimum distribution. And I think they've increased it to, I think it's 72 now. I think it is. It used to be 7.5, but I think it's 72 now. Required minimum distribution. I want you to write that down. You will have to draw down your retirement funds at 72 years of age, according to the government. It's called required minimum distribution, RMD. So he said, Steph, I can start income at 72 years old. You know, I don't really need it, but I can start it. Well, look at what this account did in just right at about 3 to 4 years. He went from 1,060,000. That account is at $1.5 million. And then he said, I want lifetime income because I'm going to have money coming in from this source. I've got money coming in from this source. And guess what Global Atlantic said? Well, you know what? We will pay you $74,000 for the rest of your life, the rest of your life. And when you pass away, your beneficiaries will receive all of the remaining funds plus all interest that you've earned in your account. $74,000. He's going to get that forever, forever. Even when his original 1,060,000 has exhausted itself, which if you divide that out at about 13, 14 years in, he would have exhausted that account. You have some people who don't know these options and they retire and they get their lump sum money and they just try to keep it in a bank and they're like spending, paying bills, not understanding inflation, not understanding taxation, and they're going to run out of money. But if you go into these contracts with some of these companies, they'll pay you forever. You can actually set the payment to stay up with inflation. What that means is that your payments will always increase because the company considers inflation for that year, and you can do an inflation payout. That's the power of this, of how that works. Provisional income. I hope that this has been helpful for you. Some other things that you need to know about retirement is when it comes to your Social Security. Many people don't know that your Social Security can be taxed. And I'd like to say that if you've worked really hard and planned pretty good and you roll a pretty substantial money over and things like that, your Social Security will be taxed. It's called provisional income. Your provisional income is just an amount that is determined whether you'll have to pay federal income taxes on a portion of your Social Security benefit. Most of the time, it's going to be the greater your provisional income is, the more likely it is that your benefits is going to be subject to income tax. So what do I mean by that? Well, provisional income, what they do is they look at about 50% of your Social Security benefit. I'm going to give an example. They take into consideration ordinary income, dividends, capital gains. So ordinary income is going to be like income from IRA plans, 401k plans, things of that nature, right? That you're pulling income off of. Dividends and capital gains. So people who say, oh, you know, I'm going to have all of this real estate in retirement. That's wonderful, but you're going to have to pay capital gain taxes on it. And they're also going to weigh it when it comes to your Social Security and whether or not you're going to have to pay taxes on it. And they also look at non-taxable interest things like municipal bonds and all of those different things too. So really quickly, this is just a quick example. This is a quick example, right? Very quick example of an individual who has their Social Security and with provisional income. right? And if there's any young people on the call, and when I say young, you're in your 20s and your 30s, right? I've been there, right? I'm still in my 30s. I'm 38 years old. This information is critical for you also, right? You need to be planning early, ahead of time. And what more, if you're in your 30s on this call, you need to be sitting in my seat teaching this information, because there's so many individuals who need this information. I want you to think about actually doing this, because we need more people talking about this. Let's look at the Social Security taxes, how to calculate provisional income. I'm going to try to explain it to you really quickly. 10 minutes and we're going to be done. I told you I'm going to respect your time. How can you calculate provisional income? Most of the people, and it's kind of sad, my own father didn't even know about provisional income. Well, let's say, for instance, you had a pension, you had 401k plan, 403b plan, and you rolled it and you got money coming out, and maybe you're going to have about $100,000. And it could be from anything. It could be from your capital gains taxes, where you have to pay, you're making a lot of income. What they're going to typically do is they look at you as a single person or married. And if you're getting about 25,000 or more on your Social Security, they're going to do 50% of it. If you're getting above 34, they're going to do 85% of it. And they're going to tell you what your taxable income is. And that means that they're going to tell you what portion of your Social Security benefit is taxable in addition to your taxable income. What do I mean by that? Well, if you're putting all of your money in a tax deferred account, what are tax deferred accounts? Well, if you have a 401k, it's tax deferred. If you have a 403b, it's tax deferred. The truth is if you read The Power of Zero, especially if you're on this call, you're in your 20s, you're in your 30s, you're in your 40s, you may want to sit down with the person who brought you on this call, or call me or someone and talk to them regarding how you can set up a tax-free retirement account, because then you can avoid having taxable income that's going to impact your Social Security. But if you're in your 50s, unless you have a large sum of money to put into those type of plans, there's something that's called the cost of waiting, and it may not be appropriate for you or applicable for you at this point, but it is something that you can teach your children and you can teach your grandchildren, right? Because if you can get to the point of retirement and not have a very high amount of taxable income, then your Social Security benefits won't be impacted as much. So let me give you an example. Let's say, for instance, you've got $100,000 of taxable income coming in. That could be from 401ks, 403bs, capital gains, anything, municipal bonds. Well, guess what they're going to do? If your Social Security is about $54,000, they're going to take 50% of that, right, which is about $27,000. And then they're going to say, well, your total taxable income that you're going to pay taxes on is $127,000. Well, the more you make, right, the more you are as a couple, then you're looking at $45,000 with that. And then you're going to be taxed on about $145,000. So I want you to understand that, yes, your Social Security benefits can be taxed. We call it provisional income. Lastly, really quickly, there are ways, though, that you can have tax-free income coming in retirement. Now, if you're in your 20s, 30s, 40s, you need to talk. You need to reach out to Joanne, Auntie Stella if she invited you, Auntie Connie if she invited you, call me if you want to. There are ways for you to set up tax-free retirement accounts where you will not be subject to taxes when you retire. And yes, you can get to a point of tax-free income. We call it, oftentimes you can do a conversion IRA plan, or you can do alert plan, right? Where the IRS allows you to be able to do that. And we teach you how to do that. What's the most important thing that most people fear? And why do I want you to take this serious? Most people are going to fear asset protection. That means that your property that you live in, your cars, everything that you've worked hard for, how are you going to protect it? How are you going to protect it now that you're getting near retirement? That's when you have to sit down with someone like Joanne or myself or Stella or Auntie Connie, Mr. William, talk about living wills, talk about trust, talk about Medicaid, Medicare, talk about things like, how can I protect myself and my assets if I were to get sick? Write this down. I hope you find this information valuable. I've told you so much valuable information in less than an hour that many people don't even know of. Write this down. There is something that is referred to as the spin down concept. Spin down. What do I mean by that? If you have assets, if you have properties, if you own things, you want to understand this. You need to have plans in place to protect your assets, because if you ever get sick, if you ever have to be put in a nursing home, or if you ever have to be put in a whatever type of facility, there is something that is called the spin down concept, where you will have to liquidate your assets first before Medicare, Medicaid, and things like that will even kick in. Basically, the state wants you to be broke before they will actually pay it out. You don't believe me? Look it up. These are things that are very important. No one wants to have to sell their property if they get sick or anything like that. Income protection, putting an umbrella around your income, making sure that you have protection in place. These are things that are so critical, not only for people who are 50 plus years old, but do you have children? Are your children in their 20s? Are your children in their 30s? You need to talk to them. You need to have them sit down, because they need to understand these things as well. If you're in your 20s, 30s, or 40s, you need to understand these things as well. You get them started when you're really young. The number one cause of poverty is chronic and critical illnesses. In closing, there are accounts that you can start that will protect your hard-earned money in the event that you get critically ill, chronically ill, terminally ill, so that you don't have to liquidate your retirement funds, go in and borrow lump sums of money and all these different types of things, that you can retire comfortably. Joanne can talk to you about this. Stella can talk to you about this. Mr. Williams can. Also, Auntie Connie can as well. There are ways for you to protect your money. We call it putting living benefits in place. Again, my name is Stephanie Njoku. I'm one of the executive vice chairmen here at World Financial Group. Very proudly partnering with so many amazing A+ rated companies. I wanted to at least come on today. Auntie Joanne, I wanted to at least share that information. I hope that you found it beneficial, and I'm going to turn it back over to Auntie Joanne and answer any questions that you guys may have. Auntie, take it away.